Absolutely.
Not quite yet. This is my show.
Burnt.
No, far from it. We had a very useful just pre-discussion this morning when the committee met to look at its agenda for next week. So, by the way, to all of you, a very exciting agenda next week for the Risk Committee. So, those of you that aren't members are most welcome, and we'll have a good agenda, which actually includes, dare I say, to follow through from Andrea and Sarah and team about our insurance update. But that'll be good. But we had a good chance to have a chat about today, and we were just reflecting. Clearly, we're here to talk about essentially our insurance strategy. I realised that we last talked about the insurance strategy, Sarah, before actually even Andrea was in the organisation. So, or indeed Wendy. So, how long ago was that?
We signed off the strategy in September 2022, so
Yep.
we'd done a bit of pre-work then, and that's when you gave us
That's
the
right.
go-ahead to continue.
That's right. So it has been existing, but actually, so September is prior to the last elections. So it is good for us as a committee, because this is an exercise in risk. It's good for us as a committee to get this workshop and an update in terms of where we're at with the insurance strategy. Fair to say, even though we are yet to go into our phase 2 workshop around what are our strategic risks, one of the critical matters which clearly is in front of us as a city is the position that we can take in the insurance market relative to the risks that we face. So this becomes really important. I had, just in my general reading, been reading a piece from America which talked about insurance in the insurance markets over there. And, you know, they're saying that in Florida, you virtually can't buy insurance. And the author or the opinion writer I was reading from is in New York, and a mile and a half at least and above and high above the sea cannot get affordable insurance for her property. And her investigation said that while the climate is changing, the model for insurance has not. So I think I leave it at that, because it's time for me to let you folk have your say. But the criticality is our risks are increasing. The insurance model is challenging to work in. And so consequently, as I've always read our insurance work program, it's designed to help us maximise what we can get. Bear in mind, we're a bit player. And in fact, what this person wrote in the article was, individuals are left to struggle through. So this, to me, in our strategy is all about, and I'd like to say this quite definitely, a welcome initiative, proaction by staff to address an issue which otherwise for us could be almost intractable. So it's a really good start. So great to be September 22, so we're about 18 months into it.
Yeah.
So it's timely for the committee to be able to get an update and take it from there. So Sarah, Andrea, team, how do you want to take this? You're going to rabbit through the
Yep.
slides and take questions as we go?
Let's leave questions to the end.
Okay.
And so we'll keep our presentation relatively short and
Yes.
simple and leave plenty of time for questions. I think that's probably going to help the flow best.
Yes.
Before we kick off, I just want to make sure everyone knows Sarah Houston Estergaard, I think, a treasurer, but also Andy Thompson. So Andy is a senior advisor within Sarah's team, and I just wanted to, I never want to start off by, outlining the work that the team does and kind of praising them, but I'm going to do so in this instance because throughout New Zealand in the local government sector, the team is recognised for the work that it's doing in the insurance space. And both Sarah and Andy have been asked to present at numerous forums on the work that we've got here in front of you, because it is challenging, and it's challenging right across New Zealand. And and in local government, we're all facing these challenges, and we do want to share our learnings and learn from each other. So, where we're at is we're probably a step ahead of where many other councils are. We're probably alongside some of the other biggies, but I just wanted to acknowledge Sarah and Andy's work in this space because it's pretty phenomenal. So, just start with that. Questions at the end. Look, what we're wanting to cover off here quite simply is what our insurance risk is and what we're looking to do to mitigate that risk. And so, we've got up on this slide, Mind the Gap, and the gap is going to become very obvious in a minute as I refer to our graph of doom that you have seen many times before. But also reflecting, well, if you don't laugh, you're going to cry. So, let's laugh. And Mind the Gap reflects also that we do get the majority of our insurance from the London market, and we're going to come to that during our presentation as well. But I really like here that we talk about our insurance and our risk financing journey, because the key point here, Bruce, if I read your comment correctly, is that you can't get insurance in the way that you've always traditionally obtained insurance. And so we need to be thinking about risk financing here, not just insurance in the traditional sense of the word, and we'll come back to that.
So just to be clear, we're talking about insurance of the Wellington City Council's
Correct.
assets, because it's also got to recognise there's an enormous insurance issue with the wider Wellington business side of things.
So,
but just to give scope to this.
Thank you.
discussion.
That's a really important point. So we are very focused on ensuring the risks of our assets, but I think what we need to recognise is people are looking at us as a significant organisation, a public sector organisation in Wellington, to show some leadership here. And people are also looking at what we're doing in terms of what can they do and learn from us as well. So, that's the start of this journey, right? We'd love to be able to help everyone, but we've got to get our stuff sorted in the first. Yeah, that's right. So this is the lovely graph of doom. Defining the gap that we have in our insurance has been our focus so far. So I just wanted to pause and take... Ben. Yeah. No offence, Ben. Thank you.
And none taken.
You were just hiding some of the graph. That was all Councillor Young was referring to.
We'll
so,
supply the notes after.
yeah, we absolutely will supply these notes as well. So, so this graph won't be unfamiliar to you. It's in our consultation document that is currently out at the moment. But stepping back into 2021, we obviously took quite a traditional approach to insuring our assets. We sought to insure assets through traditional mechanisms. That grey line at the bottom reflects the insurance cover that we did have over our assets. That's not only the insurance that we purchase, but we also recognise the other insurance mechanisms that we can draw on if we were to have a 1 in 1,000 event. So that would be EQC funding for our housing portfolio or housing stock. And it would also include central government funding through 60-40 split agreement. So it is only a cabinet minute, but it reflects that if there was some, and so this was played out in Christchurch, if there was some disaster that affected the underground assets, that providing we could fund 40% of the renewals of those assets, central government would provide the separate 60%. And that was established back in the day because, in fact, there was no appropriate, easy way to get insurance for underground assets. So most councils, or all councils in New Zealand, rely on that for their underground assets. Historically, there have been group funds across councils to, LAP, I think it was called, was it LAP? I'll look at Bruce, make sure I'm saying the right thing, where that was targeted for the 40% to fund the 40% of an infrastructure, the underground infrastructure. So that was a portfolio of councils entering into an insurance agreement together. So we had this ability where most of our assets were indeed insured. However, we did have a bit of a gap, and that we therefore took within our financial strategy the approach that we would hold that gap, or the equivalent of that gap, in our debt headroom, so that we would maintain that in reserve, so that we had covered all the risks of our asset portfolio in the case of a 1 in 1,000 year event. Now, I'm probably going to need Andy's help to explain what a 1 in 1,000 year event is, but it's within the context of Wellington, it would probably equate to something like a 7.7 magnitude earthquake on the Wellington fault line, or an 8.7 on the Wairarapa fault line. Have I got that right? Yes. And so, probably you would see quite extensive damage, but not something over and above catastrophising the whole city. The reason we need to really focus on this as well as a public sector entity is there's an absolute reliance on us in an emergency situation to be the people to start to be able to react quickly, because we're going to be the people that are looked to issue consents for rebuilding. People will expect Wellington City Council to have a level of ability to get back to normalising work. That was the same expectation that was in Christchurch. That is the same expectation that's in Auckland and in the Hawke's Bay and other places. So, that's why we've modelled the 1 in 1,000. You could model it at different levels, but that's simply the reason that we've chosen to model at that level. However, in 2022, as we were embarking on this, because we were starting to see that risk creep up and we were holding that risk in our financial strategy, and the team started working on this insurance strategy and thinking about the risks ahead of us, we had two other key things that drove this big change and that big sharp jump. One, we revalued our assets. And that created a significant increase in terms of the replacement cost of our assets and what it would cost to be able to replace those. The second thing that landed at that time was the National Seismic Hazard Model. I always think of NHS because I've got the London Mind the Gap, and that's not quite right. So National Seismic Hazard Model was released that reflected the risk in Wellington had gone up exponentially. And so our risk profile in terms of modelling for this 1 in 1,000 year event went up significantly. You can see here we're doing a really good job, though, of still maintaining the insurance coverage that we've got in the traditional way. So our grey boxes are still maintaining, and they're even going up slightly, which reflects the work that we do in trying to secure insurance in the market. But we've got a residual risk that has heightened that we need to address. Okay, and there is many different ways that we're looking to address this. The one that we're consulting on at the moment through the LTP consultation document is obviously the establishment of a perpetual investment fund, but that is one of many within the insurance roadmap that we're going to discuss with you today. So destination, we need to pivot to become a strategic purchaser of assurance and to provide better consistency and certainty on our cost of risk. And that's essentially what we're trying to do in this space. So with those introductory comments, I'm going to hand over to Sarah and Andy to talk about the 4 limbs of our insurance roadmap and break those down and the work that we're doing in each of those limbs, and then we'll start taking some questions.
Oh, I'm having that one. Whew, thanks, Andrea. The problem sounds really keeps us awake at night, I'm sure. Can you hear me? Right. So as Bruce alluded to earlier, in September 2022, we bought a report essentially with a work plan attached to it, which we named the Insurance Roadmap, being very careful to avoid the word strategy and policy and all those sorts of things for reasons that we agreed at that time. And look, what this essentially sets out is a kind of a 3 to 6 year game plan, if you like, for how we go from I guess that's at the point in time, like Andrea said, that we started this work, we actually didn't have that full view of developing up that risk. That has come about and evolved through this work. So the traditional way of placing insurance was, we've got a budget, we go and we buy insurance for that budget without really digging deeply into what's driving our insurance risk. So holistically, this insurance roadmap wants to put us, we need to put ourselves in a position where we fundamentally understand what our risk is, so that we can then deploy the right resources and put the right time and energy in the right place. So the previous slide talked about the destination. Ultimately, the destination is to fill that gap, but fill it up in a really strategic and joined up way. Minimising the gap is probably the first step, and then filling that gap with the different items that we have. So the insurance roadmap, the report is available to you. We can provide it again if you need it sort of cycled back through. But essentially we have 4 work streams that we landed on. So this was a whole lot of work we did across council. We had 20-odd hours of conversations with in conjunction with our brokers to understand council as a whole, where our assets lay, where our risks lay, who holds the information on those assets, all sorts of really great joined up conversations that brought in climate risk, legal risk, all sorts of things to come to this roadmap that's it's quite a cool document if I don't say so. But then attached to that, like I say, it has a work plan. So that work plan is broken down into 4 different areas. First being governance, which I'll touch on in a minute, and then purchasing decisions, data and understanding, and then internal relationships. And those were identified as the 4 key high-level work streams that us as a team will be responsible for delivering on, essentially, to build up our understanding of the risk in like I said, in a holistic way to council, and how we can join up that, close that gap by joining up conversations with the likes of elected members, right to, our colleagues in legal and on all sorts there. So I'll move on to the next one. So the first of those of those work plans being governance. So some of you might recall, not long after the election, we had some conversations around risk appetite and kind of how our new council, as they were forming, so it was possibly a little bit unfair about the timing on it, to be fair, but how you perceived your risk appetite that you kind of wanted to interact with us on, and we would take that as a guiding principle or a guiding principle on how we attack this. So do we want to be super aggressive and go to the market and buy all the insurance we possibly can, and who cares about the budget? Those were the sorts of leading questions we were sort of giving to you to have that feedback. And I believe we did not quite land on a joined up position in that. So we would like to revisit that with you at some stage to see if, now that you've got your feet under the table and you know us a bit better, we'd quite like to have that conversation again at some stage when it's appropriate. But this governance question was really about lifting the conversation about this risk out of our team and keeping us awake at night and sharing it with as many people as we could, right up into the decision makers of the organisation, which is you. I wasn't here a lot earlier than this, but I don't know if you had conversations at this level of, what our insurance risk was and what the implications of that was. So the intention behind this one is really to, as we go through, to inform you, to give you as much information as you need to help us make decisions in this space. And I'm going to hand over to Andy because she's the one that does all the diligent work. Oh, okay. No, I can talk about internal controls. I mentioned the risk appetite. I got a little bit ahead of myself and sort of introduced that notion of the risk appetite workshops that we had. But this is where am I at? Really throwing my flow now. So internal controls really need to be understanding what our tolerance and appetite is for taking this risk on versus, outsourcing it, if you like, which is effectively what we do when we buy insurance. The traditional insurance policy settings are, like I described, you set a budget, you buy insurance for as much as you can without sort of fully understanding it, and we don't believe that that's the right solution for where we're at in our evolution of this. So understanding what other options are to fill that gap is the journey that we're kind of going on. Sorry, Andy, now I'll pass on to you. So this is the really exciting, cool stuff for us to geek out about, so go.
Sure, thanks, Sarah. So moving into the purchasing decisions leg, as you might want to call it, this work stream is really about improving the process and analysis that we use to make our decisions, and that leads us to being able to make other risk funding purchasing decisions here at Council. So a lot of work's gone into this. We've done a couple of kind of pilot studies in a couple of our policies and had good results, resulting in increased cover on those policies. And that's been, really driven by using that analysis and improving that process around that purchase. We've got some risk modelling coming into this, and the risk modelling we think is our most important action at this stage, and will really inform all of the work streams. And so you'll see it in each work stream as we go through, because it is a shared action as well. The overall strategy here, we will be making different decisions after we have more information, which will be delivered with the risk modelling. So, Clyde Key Wharf. Sorry. So we have a standalone policy for the Clyde Key Wharf due to the agreement that we have with the ground lease. Yeah, it's an outlier. Yeah, so in the past, we have operated just on a traditional insurance model. We have diversified our traditional insurance. We have current placements in New Zealand, London and Bermuda markets, which offers us a diversity of insurers, better access to capital, and geographical diversity, making Wellington a more tempting offer. We have been restricted by limited or exhausted capital in New Zealand markets, and we also recognise that offers low diversity for us, and so as a risk mitigation, being able to diversify our traditional purchasing of insurance into other markets is a good idea. Yeah, Sarah's going to talk about London.
Sorry to chop and change, team. We'll flip back to Andy in a minute, but so Andrew and I recently went to London to do our annual weekly visit. That was lots and lots of meetings with many different underwriters. So we just tried to capture some of the key themes here from the discussions that we had when we were there. For context, last year we went to London and there was a very hand-wringing ho-hum. We have to increase your rates by astronomical amounts, and you see that probably playing out in the private market at the moment. There's a little bit of a lag effect there, but I think, what was our average increase last year? 5 to 10%. Yeah, so there was a significant increase last year because of dynamics that were playing out in the insurance market as opposed to what was happening necessarily in Wellington, noting that they were cognizant that Cyclone Gabrielle had just occurred and we had a few reasonable events leading up to last year's visit. This year it was actually quite refreshing because there was it was more positive, the theme probably that we heard from the insurers. They were, well, we haven't got the pricing yet, it's still in progress. They were a lot more circumspect, saying it's probably a flat to a small increase this year on your placement. And in fact, the messaging that we gave back to them was that where it's available, we would take more capacity. Obviously cognizant of we've got that big gap to fill, and the price is right at the moment to maybe achieve a little bit of an incremental increase there. So we're focusing that probably on the housing policy this year so that we can get sort of full cover on all of our social housing assets, but we'll take a little bit of extra on the other policies as well as we can. So completely gone off script here, Andy. But the positive feedback, yes, so they give us feedback that they highly value our annual pilgrimage to London to go and give them this message. For context, last year we had to make it really clear to the London market that we weren't just a suburb of Auckland and we hadn't been wiped out by Cyclone Gabriel for, sorry, I know that's a bit facetious, but just to give them that message that we are here, we are a distinct entity of it, and Wellington Risk is unique to the rest of New Zealand. But also delivering some really key messages. We are very proactive in our climate change response. We are doing many, many resilience projects to protect our asset base. The modelling work that Andy's doing is being received very, very well. That understanding of our own risk and to go and tell that story is just invaluable. And the pricing, so 5 to 10% last year, by others were getting 30% uplift. So that good work and us going and telling that story really plays out in the premiums we pay for the capacity we do get. So I'll hand back to Andy.
Cool. Thank you. Diving back into one of our work streams, our data understanding work stream, the main purpose of this work stream is to improve our loss information that we hold and better inform decision making and the strategic direction of our insurance and risk funding activities. We have recently completed putting together our data to go into our modelling, and we're scheduled to begin modelling in June. And our final work stream is internal partnerships. And this one is all about partnering with teams across council and ensuring that we can deliver mutually beneficial outcomes and provide up-to-date and fit-for-purpose guidance to other parts of council. We'll be, we'll be redeveloping our insurance guidelines that are available internally, which we think will help increase understanding throughout council and also improve the processes that are followed. And that's, really minor down the bottom stuff, but we should be working throughout the entire stack. Cool. We'll move on to our last slide, and we just wanted to open up for questions with this slide on the screen. So this slide shows the detailed action plan for the 23 and 24 calendar years.
And this will be available.
Yeah.
As noted, we'll share these slides. You'll hopefully have them in front of you, but Ben's face is there as well.
Right. Sorry, have you got anything more to say? You want to take?
No, happy to take questions.
Like I saw Diane, and then I've got Tony, and then Ray, and then Rebecca.
Thank you. Just the London trip, I know also a number of property owners from Wellington also go. So do you engage with them beforehand so that you're all singing from the same song sheet in terms of Wellington?
So we go with Aon being our broker, and so often they're quite cognizant and they coordinate all of that as well. from the approach that we took this year, we took a slightly different approach in providing information about the Wellington City Council context, because in preparing this long-term plan, as you know, we've had to pivot quite a lot. So we took a bit of time to explain what we were doing in the water space, what we were doing with Let's Get Wellington Moving, because going out to the insurance market and trying to insure water assets when, you know, they'd seen media that was going to be moved off our balance sheet, and then, you know, so it was really kind of discussing what our context was and our operating context. It's fair to say that most of them were quite cognizant of the Wellington context. They also talked to us. KiwiRail had just been over there, and of course they'd had to pivot majorly with the changes as well. And so, you know, they were quite cognizant of that and those risks.
Okay.
So, yeah.
And just one other question, and I know, I think I might not pronounce it quite right, but parametric insurance. And I know the stadium has started to do that, and just whether that's I won't go into detail.
Yeah, we have absolutely looked at parametric insurance.
Yeah.
We've received some information about that. I think we got a quote or looked at that, but it's something that was not going to give us any benefit at this point in time. It's not been taken off the table. We'll continue to explore it as it becomes more mature in the New Zealand market.
So is that something then in terms of just with all the CCOs, because obviously, you know, we want to make sure that we get the best for the limited funds that we do have?
Yeah, so I'll hand over to Andy.
Yeah, so in terms of CCOs, we're including CCO assets in our loss modelling so that we can assess how we can help there.
Okay, thank you.
Great to hear. Thank you, Diane. Tony?
Yes, thank you. It's a complicated subject, so thanks for taking us through this. I just wanted to maybe get an idea, you know, around the rough amounts we're talking about. You know, tripping to London is not something done lightly, but when you're talking about potentially having a 10% rates increase versus a 30% rates increase, what sort of rough amounts of money are you talking about maybe saving just from the trip?
And I think we probably had the exact same conversation last year to justify going, because we had a bit of a hiatus over, what was that thing that happened? COVID. Where we did them remotely and we were up in the middle of the night sort of talking to the markets and things like that. So we did do a rough analysis. I don't have exact numbers, but our budget for this year's total insurance spend is 25 million across the whole portfolio. So, you know, if we're saving 5 to 10% on that, it's not in that realm, but it more than
But you're talking about
justifies.
working at the seven figures.
Absolutely, and the cost of the trip would be no more than $15,000.
Oh, yes, I know. I just think it's interesting just to see how big this issue is
Yeah.
Comparatively.
And it's more the non-financial value that you get out of it, to be perfectly honest. You know, the messaging that we have. So, for context, I spoke to one underwriter last year, and she said she had 200 submissions in her inbox at any one time. And so, to them, we're a form like that in her inbox. And if she doesn't have, we spoke to many of them, but if they don't have to scroll through that and read it, and if we can tell them those messages, and more importantly, they can ask those leading questions of us when we're there and then and there, they don't have to make the assumptions over the fact that we weren't impacted by Cyclone Gabrielle and all of these sorts of things. And so it's more the intangible benefits that you get from having that face-to-face and them understanding our risk. So for us to go and understand our risk and then give that to them, they don't have to do a whole lot of work in the background. So that's how it translates through to them offering, you know, cheaper lines of insurance back to us. And that's kind of the intangible. I suppose it can be quantified, but that's the intangible piece there.
Okay. So thank you. So just a second question, I'll go back on the list if it's right. Just around partnerships, so where does a lot of our assets are underground in the water infrastructure? Do you want to quickly comment on the relationship you have with Wellington Water as sort of our delegated managers of those assets and where they fit into this discussion around insurance?
Well, ultimately, we own those assets, and the really critical element here is that we have a good relationship with them to be able to understand those assets. And you saw that through the LTP process, where we're getting a better understanding of those assets, the condition they're in, and what and what that's likely to mean if there was going to be a disaster tomorrow, and how we'd look to remedy those. So. That's the really important thing of having good asset information, and that also feeds into the work that Andy's doing in terms of the data consolidation and the loss modelling to be able to give us that information. Similarly with Te Toi Mahana around our housing assets, of course, because we own them, they manage, yeah.
Thank you.
Thanks, Tony. Just out of interest, I've got Ray, Rebecca, Laurie, Tim. So Ray, please.
Great, thanks very much. Andrea, you were saying that you went to, when you were in London, did you talk to the actual insurers? Like, do you talk to Lloyd's of London, or do we actually work through a broker here and then they actually arrange the insurance for us? Like, I'm looking at ways of cutting the cost.
Yeah, we worked through a broker, and we presented to over 45 underwriters through different sessions. So we had at least probably 15 meetings throughout the course of 3 days. So the predominant conversations were with underwriters, but through Aon, they also, going to Sarah's intangible benefit point, would be able to connect us in with other leaders within Aon who are exploring different ways of mitigating financial risk that they could discuss with us as well, and what else is happening in the market.
Mm-hmm. Okay, second question. Is that okay? With Christchurch, you were talking about that 40-60 rule. So when that earthquake hit Christchurch, did Christchurch have the funds to fund the 40%, or did central government pay for?
No, Christchurch had the funds to fund the 40%. That was largely in the pooled amount of insurance, which unfortunately has now been effectively eroded for the local government sector because of that event. So, that event was modelled on something happening in Wellington, not happening in Christchurch. It happened in Christchurch. The model then, that fund was effectively eroded. So, they took out, that was their part of the 40%, and that was matched by central government at a 60%.
Great, thank you.
I think the critical thing over the 40-60 that the team alluded to, Ray, is it's a cabinet minute. It's not enshrined. It's not actually guaranteed. Although over the last 20 years we have all operated, and generally the successive governments have kept to that commitment. It's not a certainty. Thanks, Ray. Rebecca.
I just wanted to dig a bit more into the 1 in 1,000 year, and as I've because I've been in public forums where essentially external people are sort of saying to me as a governor, well, it's foolish to and nobody in the private sector would insure to that level, and so it's kind of as if the council is kind of making as if our kind of position is kind of ludicrous.
Yeah.
So, and those are not my views, but I'm just interested in what the response would be.
It's a really good point, and comparing us to the private sector is a challenge, because how the private sector operates post a seismic or natural disaster is fundamentally different to what the public expect from our local authority, right? And so for that reason, we choose to be quite prudent in terms of what we are modelling and the expectations the public have. And we have seen that play out in Christchurch and Auckland and the Hawke's Bay. The 1 in 1,000, we feel that is an appropriate base to use for the fact that I've noted what we think that equates to. We would anticipate the kind of effect of something like that being similar to the Taiwan recent earthquake. It's likely to be affect different parts of Wellington differently. We saw that play out in Christchurch. Some suburbs were not even affected in Christchurch. We are likely to have that. But irrespective, Wellington City Council has a responsibility to respond in that kind of event. And that's why we're using this kind of 1 in 1,000 to model. Quite simply, this isn't about sort of like commercial risk. This is about what the public expects for the standard of care and the stewardship that we have in their assets. Is there anything else?
I wonder if it's also...
Oh, it's also set out, can you...
So through the Insurance Strategy 2015, we elected to use the 1 in 1,000 year as our baseline, and that is the Reserve Bank of New Zealand insurer minimum requirement.
Thank you. And so I now have Laurie, thank you, then Tim, then Geordie, and then Nicola.
Thank you. I just wanted to clarify, so the way we set our insurance, we've got a budget, so that will not alter as we go through the LTP process?
Yeah. So we do have a budget, and we're working towards that. I mean, obviously, we will need to make an assessment come 31 May, well, before then, as we start to get the quotes in, we'll look at what insurance coverage we can get, and we will certainly, we anticipate what we can get. We've modelled that. We've got a budget for that. If there are opportunities, I think Sarah specified that, that we've gone out to the market and said, if you can give us more cover, let us know how much that's going to cost, because we'd like to have that conversation, and that's where we'll come back to you as the decision makers to finalise that. So, there is two elements here: the amount of cover that we actually can get insurance for, that will be tapped out. We can't get coverage for all our assets, but then there's the cost element, and we're certainly working to a budget, but we will have that conversation with you.
Great. And to clarify, that won't be at a separate point, not that 30th of May.
No, we need to settle by 31st of May, so we would have that conversation. So even next week in the Audit and Risk Committee, we will give the indication of where things are starting to come in the PX session, so, and what that's starting to look like. So we'll have a number of underwriters giving us bids, and Andy goes through a very lengthy process of, pulling together alongside our brokers what's going to be the best mix for us.
Great. Okay, thank you. The other one was just back in our strategy with the 4 points. Can you give me an actual example of how the internal partnerships help the strategy?
So one really great example, and one that I'm particularly proud of, is in the presentations that we gave in London, we touched on all different aspects of the work that we're doing across council. So we could talk about Tākina, and we could talk about Tākina as an asset and a community hub if we were to have an event, and that could be used, the resilience aspects of Tākina, so what we're doing in the building space. Sarah talked really comprehensively about what we were doing in the climate space, the impact that we were having, not only by setting climate change targets for us as a council, but also as a city, and how unique that was in the local government context. So they understood what we're doing in that risk mitigation space. And I have completely forgotten my third point, sorry. But those are a couple of the examples of their internal partnerships, a lot around the climate change.
And just to centre it in insurance, the work stream was very much to make sure that asset owners knew that we were buying their insurance and they understood the risk associated. So it was a two-way conversation to make sure that the council is as joined up as possible in this space, so we don't have insurance policies over here, despite the earlier comment about Clarkey Wolf. Like, we have everything as joined up as possible. We talk to our friends in legal to make sure that when contracts are being signed on behalf of insurance, Andy is a pseudo lawyer, though don't write that down, she's not qualified, but she's constantly feeding information from an insurance context into lots of other parts, and it was supposed to be a proactive approach to this that has historically been done in a silo. So, those guys over there, they do insurance, and so we'll leave it to them. We make sure that we are talking to other people about this. And but there's just a few comments up there, Laurie, on the slide to say where we've kind of touched there.
I was going to highlight the waterfront example, so thank you for the slide. The waterfront example is an excellent example where we went through our policy and looked at the assets last year to really define what, with the waterfront team, what are we actually insuring here? What assets would we replace? What are we doing here? So it's having that two-way conversation.
Laurie. Tim.
Actually, a number of my questions have been answered, but no, but I had a long list. So one of them was you mentioned that you're thinking of increasing the insurance cover of our social housing portfolio. Who decides? I mean, of the $756 million worth of insurance cover, is it actually like we could allocate it ourselves, or is that specifically for? So I've got two questions. So one is the specific allocation question, and the other is who decides? I mean, do we councillors decide? Do we get to say we don't want to insure the social housing, we'd like to insure the pipes, or do you guys decide?
So for your first question, we buy 4 specific material damage policies. When we're talking about assets, they're covered under those 4 policies. Those are above ground, below ground, housing and waterfront. And each of those policies has its own value for a 1 in 1,000 year event that we then look to insure to. That's not to say that we do insure to that level, but each policy has its own limit.
Right.
No.
So you can't. Okay, right.
Yeah.
So who decides?
So that's based on the loss modelling that we last got done in 2018.
I mean, does the buck stop with us? Do we have the final say, or do you guys have the final say? Do we say get it, buy the stuff, and then you allocate it, or do we say we want to insure pipes, not houses?
So that's something that we will look to bring back to you. Once we have new loss modelling, we'll be looking for guidance on how we want to allocate the gap.
Okay. And my other
So just to be clear on that, we won't be doing that this year because we're working on the 2018 data, although if we want to, if we get the option to reinsure, we'll certainly have that conversation. But we're looking at the loss modelling in our squiggly diagram over the course of these next 2 calendar years, and then that's when we'll have that conversation again to bring that back.
right. And
Sorry, Tim, I think if I'm understanding your question correctly, it's about how you allocate the different spends of the insurance. A lot of that is largely market driven. So we obviously put the policy out there. The work that Andy does from between now and 31 May it's a work of art. It's a massive big what's the word for it? Mud map, and tiny little pieces are taken by all of these 47 underwriters plus whoever else we didn't talk to, and they will. So the market will decide where they want to bid into for that pricing. So we work alongside our brokers to build up that that stack. There's ventilation in different parts, which means effectively we can't achieve pricing because the market isn't willing to offer it to us all the way up through the risk stack, so we do it in layers. But essentially, we take what the market quotes to us and then we decide yes or no. If it's too expensive, we will look to transfer that to another more cost-effective one, or we will choose to take that risk on ourselves through self-insurance, etc. So at the moment, that's how it works. But from a big holistic picture, we'll do this modelling, we'll come back and we'll say, well, you tell us where you want to allocate the budget, and then we will go through this process again to allocate the spend.
Sort of related, well, not really related. So obviously our insurance costs have risen a lot per dollar cover, and the Reserve Bank report that I've sent you the link indicates that household insurance costs in Wellington have gone up 96% in since 2017, and that Wellington's household insurance costs have gone up pretty much twice the rate of the rest of New Zealand in real terms, if you take, and that's even with the EQC adjustment, which is obviously not risk-based pricing. So it's sort of like, obviously the risk factor of Wellington is, got pretty grim. But do we go and compare our pricing to others? And I was sort of looking, I had a look at Wellington Airport's, because they itemise their insurance spend, and it's trebled basically since I left. I mean, obviously.
No correlation there, I'm sure.
You don't look at. I was thinking about other councils. Do you compare us to others?
Look, we don't on a like for like basis. Probably our closest proxy would be the local area ones like Hart, Porirua, because they are exposed to the same risk as us. Ultimately, Wellington has always been assumed to be the earthquake zone where the risk has, well, that's where we choose to live. And so that interpretation of that by the market, they have modelling, they do all those sorts of things. They're comparing us to San Francisco or Tokyo and things like that that have a similar earthquake risk. So a pure like for like with other councils, just it doesn't translate as nice as that would be otherwise. Yeah. Sorry. The sum insured. Yeah.
My completely unrelated question now is, when I looked at the Deloitte report about the cost to Christchurch City Council of the 2011 event, and I asked Treasury about this, they said it's now about 15 billion to the City Council, which seems to dwarf your estimate in terms of the cost of rebuild if we have a similar scale event in Wellington. So, I mean, I know you've said...
Is the 15 billion to Christchurch City, or is it to the neighbouring councils as well?
Christchurch City.
Christchurch City, yeah.
And I just sort of, I mean, our number looks, you know, compared to the replacement cost of the various bits of our asset base.
Yeah, our asset base is substantially lower than Christchurch City's, though, in a total.
Cost.
Yeah, true.
And the vicinity of Wellington, so that our city limits are a lot more compact and confined, and so therefore the amount of assets we can squeeze into there compared to a Christchurch, which is very sprawling and, you know, far-reaching. I don't know how you would compare that. We can... I just, yeah, we're a compact little city and with all the blessings that go along with that.
My very last question, probably.
Thank you, Tim.
Is that given that we don't have enough cover by a long shot to cover, you know, rebuild, when would we decide where we were going to spend our available financial resource? Could we decide in advance, or is that going to be something for a council after a disaster?
Well, I think that's ultimately a policy decision for you guys to make in terms of how much risk that you're willing to take, and that's the importance of the governance component.
Last question. Do you guys all live in Wellington? No.
Close by.
No, look, Tim, I'm very interested, Tim, in your comments around decision-making rights, and this is why I'm very keen the Risk Committee keeps this in its sight, Tim, because it is on. Yeah. Is that better? Sorry, I'm very keen that we keep this in front of the committee. This is actually the reason why the roadmap is with us. We've acknowledged in the slides that there is a very rudimentary risk appetite statement, and it is our responsibility on behalf of elected members to develop that further, which, while that's at a high and a more strategic level, is then starting to help Andrea and Sarah and Andy start to work out that allocation that you're talking about. So my view is actually we have a strong role to play in this, but it's hand in hand with the development of the roadmap they're taking us through, which we've agreed and signed off on. Look, I've got Geordie, Nicola, and then I want to insert Wendy because they're first-time questioners, and then I'll come back to Tony and Ray. Geordie?
Yeah, maybe I'm jumping ahead of this and you can say ask again in a couple of years, but in terms of like the looking at alternative models for risk transfer, I mean, looking at the graph where it looks like the ability for the market to absorb risk transfer is, while it's increasing, is not increasing as fast as the value of our assets. Does it feel like in a way we are going to have to start looking at different ways of managing our risk beyond just risk transfer?
Yeah, well, I think we're proposing to do that now through the establishment of the Perpetual Investment Fund, because that is all about managing our risk, which is having one asset that is completely, exposed in the same way we are to diversifying that. But again, we'll continue to explore many other available options, Councillor Calvert raised parametric, we're continuing to explore all of those things, so nothing's off the table.
Does it kind of feel like we wouldn't get back to a position where transferring risk was kind of the way that you managed it it used to be?
I can't see it returning that way at all. I think that, Bruce's quote right at the very beginning, the insurance market is fundamentally changed and we need to change as a result.
Yeah, thank you very much.
Thanks, Geordie. Nicola?
Wondering, do we know what percent, bearing in mind we're a very compact city, do we know roughly what percentage of our assets are in the high shake zone and then the rupture zone?
Yeah, that's what the modelling will help us define, but no, not at this point.
Okay, thank you.
That'll be the really interesting information that comes back.
If
So
you ever
roughly,
wanna geek out about
roughly the
earthquakes.
timeline for that information, Andy, that's what you're going into in the 24-25 year, correct?
So we'll be starting this earthquake loss modelling in June, so that's
Yeah.
a month or so away.
And in your roadmap, when does that get completed?
That should be completed by the end of this calendar year.
By the end of this calendar year.
Which will enable us to use the results of that for the 2025 renewal.
Brilliant. Great. And that's probably a good marker also when we need to think through our risk appetite posture so that we can help. Thank you for that. Thanks. Good question, Nicola. Wendy.
Thank you. I had two, but I think the first one's probably been answered by this question, which was just getting my head around that it's a 2018 loss modelling, whereas we know we've got a lot more recent sort of risk information, wearing different hats, and the National Seismic Hazard Model is obviously one source, but things have moved on as well. But so fundamentally, does that mean that the size, the estimation of the risk, the loss, the 1 in 1,000 at this stage, has not accounted for the changes in our understanding of the land we live on and, the earthquake risk? I'm just trying to sort of get my head around the impacts.
So what we did was we did an interim update to the 2018 modelling. So that was on a different basis, and a basis that we wouldn't use for decision making, but to give us an indication of where we might sit.
Right. Okay. Thank you.
Thanks.
And my second question was just really, it sounds like there's been some really great work that's gone on to sort of get a better understanding of asset condition and understanding of the risk through the risk modelling. And through the internal partnerships, have we sort of also, because I'm aware, once again, other infrastructure owners sort of starting to think about the nature of their role, short, medium term, long term, and where does the insurance products best fit, given the length of time you might take to actually negotiate outcomes from insurance products, and what is the place of, is that factor into your risk financing thinking?
Yeah, it does actually, and we're sort of evolving in our thinking here. So obviously the traditional approach is very transactional. You buy a year's worth of insurance and you repeat the cycle each year. By contrast, so Andrea and I had a conversation in London with an expert who was talking about catastrophe bonds, which are a 3-year option. So that's using other people's investors' capital into a vehicle, whether we own it or not. Sorry, far too much detail. But essentially, we will fill that gap with diversified options, if that makes sense. And that was just one example of where that was a 3-year. Not set and forget, but rather than this very transactional process that we know we will still have to continue with for part of the portfolio, but there's other options that we're exploring as well.
Folk, we have 2 minutes left, and I've got 2 sets of questions, one from Tony and one from Ray, so please.
Okay, so I'll just pick one question, it's only fair. Just going to the long-term plan and the proposal around the sale of airport shares, I just wanted you to comment around the impact of what the plan is in terms of how much money this Green Resilience Fund would possibly be able to be set aside, but also about what the plan is on the insurance headroom, just to those two together. So
the first step here is we don't want to preempt the outcome of the consultation process. So we would need to wait and see what the outcome of that process is, and then we'd need to clearly set some quite strict parameters around the perpetual investment fund, and that's something that would be clearly ring-fenced and earmarked as a as an investment fund. What parameters we'd set around, risk mitigation would have to be part of the decision-making process, and that is not being proposed at this point in time, and nor has it been defined by us. That would be an elected member decision and would have to come later in the process. If the council was to not set up that fund, we need to think about the impact of that. And currently, we are suggesting in our financial strategy that we've got that 272 million headroom. That is still inadequate. That is inadequate. We used that as a proxy in 2021. That is now woefully inadequate for what we need. We're still holding that. But if we weren't to establish that perpetual investment fund, it would be difficult to continue with our current rates of capital expenditure because we're not going to have the debt capacity and we're not going to have any alternative risk transfer mechanisms, i.e. the debt headroom that we have available.
Okay, thank you.
Thanks, Tony. Ray, final question.
Yep, I just want to ask, you were mentioning about the insurance companies would come to us and say, this is the coverage that we'll actually offer you. And so, but of course, that's not going to be covering 100% of our assets. So at the moment, what percentage do we have covered by insurance? And is it likely that the insurance companies would come back and offer a less amount of coverage?
So at the moment, our insurance covers $750 million worth of our assets approximately in the event of a 1 in 1,000 year event. So yeah, it's not, you can't say which assets are or aren't included in that, but that's the amount of coverage that we get, that we report in our annual report. That's the best proxy we can give you.
Okay, so when they come back and offer, say, they'll come back and say, okay, we'll give you 800 million of coverage. So they're not concerned about the total, our total asset base at all.
They are to a point. So the total insured value on each policy drives the rate per dollar of insurance that we purchase. So the assets that we hold in each policy drive the rate for insurance on that policy.
I see. Okay, thank you.
Thank you. Look, we are out of time, but I'm just conscious I've got Ben and I think even Councillor Sarah on the line. Just to check there's no questions from those folk, given everybody else had a good crack. Looks like...
No, that's all good.
No hands up. That seems to be okay. Thanks for being here, you guys. Thank you for that. So just as a teaser for the meeting next week, what are you bringing next week to the meeting, Sarah?
Sarah?
Oh, actually, it's Andrea, isn't it? Because you're away. Andrea, what are you bringing next week?
Yeah, Sarah's leaving. Only for the day. No, so there will be a paper that updates on the progress. So we'll cover the content that we've discussed here largely today on the insurance roadmap. It will talk about the process that we're in regards to seeking cover for our material damage portfolio, for 3 of our 4 material damage cover policies. Thank you. And so that will be the key thing. And of course, in PX, we're likely to be in a position to give an update of where things are landing based on the fact that we're looking to renew by the 31st of May.
Okay, so it's an important meeting given that at the end of the month you need to roll over on 3 of these 4 things. So that'd be useful. So there's a good reason to be at a meeting. The 8th of May. Okay, rightio. Thank you, you 3. That's tremendous to get that insight. Obviously, we're going to invite you back in this sort of situation for more work in terms of telling us where the roadmap is, but it's clearly going to be around that loss modelling, Andy. I'd be very interested to see how it goes and what are the implications for the options that are in front of us. So thank you again. Appreciate your time. Members, thank you for the time given us and your questions. Do appreciate it. Catch you guys later.